Okay, here we go. Well, Robert, Karen, thanks very much for coming on the podcast tonight. I want to thank our sponsors, Sam, Buck Mason, great apparel company.
And mask company.
Yeah, they're making masks now. I just got a mask. So we really want to talk about what everyone's talking about right now, which is the Nifty 50 in the late 60s, early 70s. So Robert, where were you during the Nifty 50? Where should we start? This is such an amazing topic, especially tonight with, Tesla just had earnings. So we have the Nifty 5 now.
Yeah, well, there's some parallels, but also there are a lot of differences, obviously. I came in the business in 1968.
Okay.
So I've just been around for a couple of years when this phenomenon arrived and the horrendous bear market that followed it. And perhaps it's worth giving a little of the economic background. It was a very turbulent time. The US dollar had been fixed to the other currencies under the Bretton Woods Agreement at the end of the war. And of course, in the following 20 odd years, countries like Japan and Germany in particular had recovered from being basket cases to being competitive economies. And the exchange rates that were set after the war were totally inappropriate.
Right.
And also, under the Bretton Woods Agreement, you could exchange dollars into gold. And so the US was running large deficits, trade deficits, and the European countries and Japan were piling up dollars. And at one point, General de Gaulle said he didn't really think it was a good deal that he was selling goods for paper. He preferred to sell it for gold. Mm-hmm. And so he started to exchange his dollars for gold. And at the same time, growth was strong, but inflation was starting to pick up in the US, and money supply was growing extremely rapidly. Anyway, in August.
Robert, you just graduated from Oxford. Were you living in London then, or were you in New York or Los Angeles?
I was in London.
You were in London, okay.
I graduated in 1964 from Oxford, and then I worked briefly in the US in the real estate business.
Okay.
And I worked in the British Civil Service for a short while, and then came to the investment business in London in 1968.
Okay.
I was working on the desk for a British investment firm, so following this very closely. Anyway, in August 1981, Nixon cut the link between dollars and gold.
71?
Introduced
1971.
Sorry, 1971, yeah. And introduced 3-month price controls. This wasn't enough to settle things. Indeed, maybe it's worth telling a story if I have time. I joined Capital in Geneva in October 1972. So at the end of 71, there was a Smithsonian agreement which allowed some changes in exchange rates, relatively minor ones, the kind of stuff that these days with fluctuating exchange rates you could have in a few months.
Yeah.
And it wasn't enough. And so more pressure grew up on the dollar. US dollar money supply grew, inflation pressures were increasing. As I say, I joined Capital in October 72. And I always remember I went to a presentation by the Chase Manhattan Bank economist, and he explained that his biggest worry was inflation, still quite low by what happened later. And then somebody said to him, didn't you see the announcement on more price controls last night I never seen a person more caught out by a question.
Yeah.
Obviously not overnight and hadn't seen the press. It taught me a lesson. Before I went to any client meeting, I always called the trading room and found out whether there's any late breaking news, just in case. Anyway, and eventually, of course, in March '73, the whole thing broke down. We moved to floating exchange rates. So in this build-up, this very uncertain build-up here, price control, inflationary pressures, the bond market was going down, interest rates were starting to rise. And the broad market was starting to soften, and it became more and more the popular theory in the investment world that the only way to get through this was to buy the stock of the highest quality growth companies, which have shown an ability to grow by 15% per annum forever, and will continue to do so forever. And therefore, it didn't matter what you paid, because you just had to own these things. And if you paid a bit too much, it didn't really matter, because with the compounding growth, in 2 or 3 years, they'd be very reasonably valued again, and it would all pay off. And like many things in the investment business, it got carried to extremes. And I was able to dig out a list. There was no official list of what we call Nifty 50.
Yeah.
It was a casual term, but it certainly included the following. I'm going to start from the top. This is the company, and then the 1972 PE. Polaroid, 91. 86. Magic Investments, that was Mortgage Guarantee Insurance Corporation, which got killed in a later real estate crash, 83. Walt Disney, 82. Baxter Travanel at 78. International Flavors and Fragrances, 75. Avon Products, 65. Emory Air Freight, 62. Johnson Johnson, 62. Digital Equipment, now gone, 60. Kresge, now Kmart, 54. Simplicity Patent, that was a name I'd forgotten all about. You may remember that, Karen.
I did, I followed it.
They were saying sewing kits to ladies, right? Wasn't that the deal?
Patterns.
Patents. Yeah, yeah. Well, it was worth 53 times earnings. AMP, the connected company, was still around, 52 times earnings. Black & Decker, 51. Schering, 51. Later Schering Plough. American Hospital Supply, 50. Schlumberger, 50. Burroughs, 49. Long gone. The computer company, Xerox, 49. Gone. Eastman Kodak, 48. Gone. Coca-Cola, 48. Texas Instruments, 46. Eli Lilly, 46. Merck, 46. Upjohn, 41. Cheeseman Ponds, 41. Minnesota Mining, 41. American Express, 39. American Home Products, 39. Schlitz Brewing, gone, 39. Halliburton, 38. IBM, 37. I better stop there.
Yeah.
I think you get a feel for these companies.
Karen, can I ask you a question?
Yes, sir.
What was the Wall Street earnings estimate? How did you get it back then? How many analysts were covering these companies? How were they communicating with the companies? What was diligence like? How did you get those numbers?
Well, there are a lot of consumer products companies on that list, as you gathered, and they were very broad in terms of what they told you. I think Coca-Cola had a 6-page annual report about that time. They didn't learn very much by looking at it.
Yeah.
And other companies were very communicative. So Avon would talk all the time, and that's how they got up there.
Yeah.
And Coke, it was mystery, kind of, and the mystery of it created the excitement.
Okay. Now, were you flying to meet with these people? Were you talking to them on the phone? Were they like, what was the correspondence? How did it work? No email.
Well, yeah, I was stationed in New York until the fall of '68.
Okay.
And then I went back to LA. And yeah, we take a plane, go see them.
Wow.
And of course, I think company meetings were more valuable in those days, not because you got inside information, but so many less people were doing them. And
That's
so
right.
got information which is not generally known. That's much more difficult today.
You go to
Yeah.
jail for that now.
Jim, are you playing
It
Words
wasn't
with
necessarily
Friends?
inside information.
No.
Are you
I'm
playing Words
reading
with
some-
Friends, Jim?
I'm reading some news.
Okay.
Sorry.
We're doing research. We want your perspective too, Jim, because we want to know
Oh,
how this compares to the late 90s. So did you know during that time, Robert, that you were in a period that people would talk about, forever, or refer back to ever?
They'd be taught in school forever.
It seemed to be crazy. I before I joined Capital Administration, which was a growth firm, but even we had trouble with the multiples that were becoming prevalent. Capital went the other extreme. They were buying all of this stuff, were buying cyclicals. And in fact, the story around Wall Street was Capital only buying if it rusts.
Yeah.
And chemicals and metals, and
Yeah.
which were all very, very depressed. But depressed, it appeared, for good reason, because although the economies were strong, you had all these price controls and all these other things. So they were completely out of favor.
Yeah.
At some point, when I'll go on to the second half of the story, is when it all collapses.
The companies now that people think about, they seem to be connected to something. Was the Nifty 50 connected to any big secular change or thematic, or is it more just the economic backdrop?
I think it was primarily a belief in consistent above average earnings and above average dividend growth.
Okay.
But they didn't care what they paid for that.
Wow.
I mean, and some of them, of course, it was right. I mean, the drug stocks, on the whole, they did stay as above average growers for decades.
Yeah.
And Disney stayed a strong grower for a long, long time.
Yeah.
So some were right. Others, it turned out, to have feet of clay. Some turned out to have feet of clay very quickly.
Yeah.
Others, it took longer, like Boyd or Xerox, before the feet of clay were revealed. One which is not mentioned here, but I remember, was Citicorp.
Yeah.
Citicorp is a bank, and that's not what you think of normally as a growth stock with a moat or anything like that. But it was the most international bank at the time, and had built a great record on expanding all around the world. And I think that got up to 40, 50 times. And
Yeah.
of course, that one got absolutely killed when the bear market came very, very quickly.
Yeah. Jim, how come you think these start and stop, these trends where everyone does the same thing, follows, takes it to extremes? What causes it?
what causes a start and stop?
Yeah, like when you look at those companies trading at those multiples, everyone knows it's not sustainable, but they can't help themselves.
It's it's the same as you talked about in the late 90s during the tech bubble. I mean, people didn't want to miss out, so they chased after certain companies and stocks that they thought was going to grow forever. I mean, it's happening today to some extent, but
Quick
By
question.
the way, the best one in the group was Walmart.
yeah.
It compounded at nearly 30% a year after that.
Walmart was the one which you bought in that group, which I know it's on the list here, but it was the one which did prove itself, turned out to be a great, not just a great company with great earnings, which some of the others did, but also actually a great investment.
Yeah, still a great company. I won't comment on the investment, but they just started driving movie theaters for folks to go watch movies. Karen, did you see that in some of their stores in the world?
Yeah, right.
That's great. Sam, you were going to say?
Obviously, in today's day and age, we have like Robinhood, E-Trade, things like that. You have quick access. Jim, in the late 90s, how were people investing that fast? And same with you guys, Robert and Karen. Like, obviously you're using brokers back then, but you're not getting the same transaction. I mean, you look at today's day, it's, you can have 10,000 investors immediately buy something, 100,000 investors. They can skyrocket a stock.
Well, I mean, in the late 90s, we had the IPO bubbles. Like we had all these internet companies that came public, and there was huge demand, a huge rush to buy these things from, especially the retail side. So, and there were a lot of brokers, very willing to put them out there and get them sold.
There was also, in this period, there was kind of a consolidation of pension money in the banks, New York banks. Right, Robert?
Yeah.
And they were like chasing each other.
Oh,
It's like the country club effect. You
Yeah.
gotta go talk about it at the club, what they bought.
so was there a retail component to the Nifty 50?
I don't know the answer to that question, Karen, do you? There must
You
be.
mean retail investors or retail companies?
Retail investors.
Investors, like, were there a lot of like people?
No, not so much. No.
Not
Those
as
all the big banks.
Yeah, there was no NASDAQ back then, so you have to go through the New York Stock Exchange, and it was harder to do.
Okay, you had to have a broker.
Yeah.
Okay.
Well, there was a small OTC market, but that's a different area. That was all small companies in those days.
Yeah.
That's when I had great results.
This is, this is hard. It's such a different world. It's hard to fathom, especially for people.
I think
you didn't. We're retail
parallel.
investors. Sorry.
I was going to say, I think
Go
the
ahead, Rob.
parallel today is more with Facebook, Amazon, and this group, Google. I.e., they are very high quality companies with very strong earnings models. So this is different from some of the speculative companies that Jim was talking about in the 90s.
Well, I mean, but 90s we also had Microsoft, Yahoo, Cisco. I mean, there were some great companies that just had very high valuations.
Yeah, it was more than that lot. Microsoft, Cisco, Northern Telecom, which turned out to have legs.
Yeah.
Nokia.
BlackBerry.
Yeah.
Well, I mean, the 90s we had the triple witching hour, right? The Y2K, we had internet growth, and then wireless telephone growth. So those three were really driving, growth and demand. And then 2000 hit, and those demand really just fell apart.
Yeah. Yeah, that's what's interesting about the Nifty 50. There are a couple great companies in there that but they're not probably the same companies where they were back then. They've evolved and changed over time.
Yeah, I mean, 20 years from now, companies like Amazon, Facebook, Tesla, Netflix could all be gone. I mean, you don't know.
Well, they may not be gone, but they may not have the growth.
Right. I mean, but 20 years from now, people will be looking back and saying, why did people pay so much for Amazon or Netflix,
Were there companies back then in the group that you thought were not going to make it, or it made less sense that they traded those lofty multiples?
I think, I mean, you talk about the multiples, obviously, but the companies were all good quality companies.
Yeah. That's the thing. You don't know.
Maybe silly.
I don't remember Louisiana Land and Exploration.
That was an oil company.
Ah,
But that's only sold 26 times on this list. So that was Nifty 50.
that was reasonable.
That was cheap money then. That was a cheap investment.
Yeah, that was,
So how do you participate in that market but not get carried away? Because you have to invest. That's your job. And you have to drive good performance, but you don't want to get carried away because you may know on the other side of this, it doesn't look too pretty. So maybe that's the second half, Robert, of the story.
yeah. Well, I guess there were, as usual in these situations, there were people who did very well in it and then went over the top. and there were people who went out early and suffered for a long time, and then did very well, or relatively well, not to say very well, but relatively well in the subsequent period. Because the subsequent
did capital have
period,
4-year rolling average back then too, for results?
Yes.
Okay.
Yes.
So that helped smooth out compensation at least.
It was said at that time that capital sold more shares in those companies than anybody ever owned,
Yeah.
because the institutional business was growing, and it would come in full of these names and they'd be sold.
that's
Wow.
right.
That's
But
interesting.
compensation wasn't in the remote area where it became later on. Capital was not such a profitable company. And anyway, then of course disaster occurred, the 73-74 bear market, which is by far the worst in my career, much worse than 2008, 2007-8, or anything else. And it had two phases. Firstly, with interest rates rising, the market finally recognized that this stuff was not all the whole market valuations were under question.
Well, look, I think for me, the question is, are we going to have a 2020, 2021 bear market that's going to rival?
Well, the parallel would be that if interest rates go up to 4%.
You better talk about what caused that, though. The oil embargo.
Well, that was the second part. So the market started to go down. I remember this extremely well because I joined in October 72.
Yeah.
On January the 1st, 73, I was given a portfolio with American orientation, U.S. orientation. The Dow peaked on January the 3rd, 973, at 1050. Over the following 2 years, it fell 48%.
Wow.
The London market on the old FT30 peaked about the same week at 530, and then went down to 160, down 72%. And the Hong Kong market went down 90%.
Jeez. Wow.
And there were two phases. Firstly, interest rates rising, so a classic kind of bear market. And then October 73, there was the oil embargo. And what was behind this was, until 972, the US was not an oil importer, which people forget. And then around 72, or maybe it was shaded around then, the US started to import oil. And that's greatly changed the position of the Middle East exporters. And so in October 73, October 73, for political reasons, they created the first oil embargo, and oil went from $3 to $12. So it quadrupled.
So this is when there's
a time when oil was a much bigger part of the right. Well, yes, because there were price controls. Actually, in Europe there were no lines, but in the US you had price controls, so all the oil was sent to you. So there were big shortages in the US. But anyway, it went up 4 times. So it both killed the economy and it also created inflation. Okay. So inflation started to go through the roof. And there were two reactions. The US and UK hesitated to put on the brakes because they were afraid of more unemployment and the usual kind of things. And so US inflation went up to over 10% in 74, and UK went to 25. that's why this bear market was so bad, because you heard the nominal declines, the 48% and the 70% and so on. But in real terms, these were even worse because the value of money was, going down so fast. And for companies, cash flow is utter disaster because you bought some stock, you made something out of it, you sold it at a profit, you thought, then you had to buy the next lot of stock, and the price had gone up 30 to 20%, and your profit was gone. So people started running into huge cash flow problems. So the 74 was an absolute horrendous period. And
Now there was political issues too, right? There were political issues, global political issues in the U.S. that were causing problems as well.
Well, because it was Nixon, and Nixon was trying to hold on to the election. That was why he had price controls, was trying to make things better for the election. He had a very weak Fed governor, Bill Miller, who didn't really do anything very tough. And then, of course, we had the Vietnam War, which was in its stages. And that was pressure on all sorts of things. So when we did recover in 75, I might add, in contrast, Germany and Switzerland really put the brakes on, and a very nasty but shorter recession.
How does the Nifty 50? How does the Nifty 50 fit into this picture? So are people focused on selling those companies more than they were selling the market?
Yes, but because what happened was there were two reasons for selling the Nifty 50. One, in an inflationary period, actually the commodity companies, oil companies obviously, but also commodities generally, started to do relatively well. A lot of them actually had rising earnings, while a lot of consumer companies ran into all sorts of problems. And secondly, of course, insofar as there was a theoretical basis for these high valuations, it was based on low interest rates, a low discount rate of future growth. And of course, as these interest rates went up, you discounted this future growth at a lower rate. And so you had some horrendous declines. I just took down Polaroid between the peak in 73 and the bottom at the end of 74 went down 91%. Avon Products went down 86%. Xerox went down 71%. Those are only three I found easily, but the others were equally bad. And the second longer term consequence of the Nifty 50 was actually they underperformed for many years afterwards, because many of them, because partly as their earnings had gone down, the valuations were still quite high. Not as crazy as they had been, but still quite high.
Right.
And during the inflationary growth or stagflationary growth we had in the 70s, when inflation remained quite high, so it was finally killed by Volcker in 81, 82. On the whole, with interest rates around 5, 6, 7, on the whole, the inflation beneficiaries did relatively well, and the high multiple companies continued to come under pressure. And the classic example of that, I remember, we had a drug analyst who joined us in January 1973, peak of this area, and he did his industry review, and he came out and said, all these valuations are crazy, don't buy anything. And so for years he didn't own anything. And
people say, why did we hire this guy?
But then in 1982, this is after the second washout after the Volcker recession, and when inflation was finally killed, Merck was down at 12 times earnings. So it had gone from 46 in 72 down to 12 in 82. So even though earnings had grown in that period, it had been a very poor stock.
Yeah, right.
And he piled into Merck and some other drug companies and made his reputation for that move. So it was the decline of the Nifty 50, and some had collapsed like Polaroid, but many of them, it's a gradual erosion which lasted for 10 years.
And were there
I looked at a bunch of them, and typically they took 15 plus years to get back to where they were. The only exception I saw was Philip Morris. Took 2 years. It's because it never got the multiple that the others did.
Were there short sellers in that market? Were there hedge funds that were short, or in the market, did you have investors that short stocks like this?
A few, but it was a very small.
Oh yeah.
Nothing like today.
Nothing like. What were we going to say, Sam?
I was just saying it sounded like a reset for basically everybody, some longer than others.
Exactly.
Kind of
But
start over.
I guess you could imagine a parallel with Amazon, which is, I think now it's 100 times earnings. Now, admittedly, the earnings are understated because of a lot of investments and so on. So the real earnings power is maybe higher and the multiple really lower. But leaving that aside, you can imagine a situation in which in 15 years' time, it's growing in line with GNP or something.
Yeah.
The P has gone down to whatever the average P is at that time.
Yeah.
And in which case it might not be a good start.
So what do you think the companies should have done, Jim, in the Nifty 50?
The Nifty 50s? Those companies should have sold a lot of equity and then used it to, have a big party.
Like, do you think
That sounds more like the late 90s, Jim.
Yeah, that happened too.
Do you think we go through these cycles and there's little to learn, or do you think you?
Yeah, it doesn't seem like anybody's learned anything.
What about you, Karen? Are there things that the company should have learned and should have done differently, or is it just it's too hard to look back and?
Should have the companies took advantage, I suppose. They do warns, but I think the honest ones couldn't believe it themselves.
Yeah. Yeah.
And also, frankly, people were very less oriented towards their stock price in those days than modern management. Stock options were much less of a factor in compensation.
In comp. Yep.
So these companies didn't sell stock or buy back stock or anything to any degree, and they just kept running their businesses. And the ones who had good businesses, and say the businesses on the whole, did reasonably well. It was not so much. There wasn't much they could do about the stock price, even if they wanted to.
Yeah.
Yeah.
Was the Nifty 50 during its period talked about in the way that maybe people talk about what Sam mentioned, Robinhood, or what Jim invested through, with the .com bubble? It seemed like that took on a life outside of the investment industry. Was the Nifty 50 like that too, where you had just normal people talking about these stocks?
Good question. I don't remember. I don't think normal people were that invested in the market.
Yeah.
Okay.
So it wasn't a matter of conversation.
Okay.
And the other thing, of course, was in 1973, this horrendous bear market, 1774, no one wanted to be in the investment business.
Yeah.
It hadn't been a hot place before, and it wasn't a hot place then. They wanted to be in the oil business. And in fact, when Capital was trying to hire analysts we had a hiring freeze, obviously, during the crash. And then when we came to hire analysts again in 1976, we had a lot of difficulty in finding anyone. No one wanted to come into the business. Now we have want to join. Not at all.
One of the interesting things is though, Capital did hire 4 or 5 analysts in 73, 72, 73, and only one of them still remained after about 10 years.
Wow.
They couldn't adjust, having gone through the bear market like that.
Yeah.
They couldn't adjust to a market that goes up.
Yeah. Because they became so risk averse? Is that why? Or
Yes.
because, yeah.
Yes.
Jim, did you tell me people that start out in bear markets, they're tougher? Did you say that?
Yeah, they are.
Someone used to say that, I forget at Capital, maybe it was Bill, they would say like, if you start out, it's tougher, you'll be better. But I don't know how it was put, but. So you found that they couldn't adjust, it was just so bad, Karen, that they couldn't get excited about companies.
Yeah, exactly.
Wow. So Robert, what do you think about the companies right now that people seem to be giving very high multiples and believing they can grow forever and can do no wrong?
Well, obviously, some of the same concerns, but I have to say, a lot of companies have some advantages over the ones of the Nifty 50. And particularly internet companies don't need capital investment to grow, roughly speaking. So, profit margins can remain high, much higher than the kind of traditional companies that were in the Nifty 50. They all seem to become more monopolistic. Most of these companies had competitors. They were leaders, but they weren't the only one.
Yeah. Okay.
So margins were nothing like what the present lot enjoy. And the multiples of the present lot, particularly if you adjust Amazon, are not yet at the levels of this level, I would argue. And interest rates are actually lower.
Yeah.
So as long as you can keep these interest rates, it doesn't, I guess sooner or later there'll be retribution, but it doesn't seem any reason for it in a big way in the short term.
Well, I mean, interest rates are one thing, but I mean, the economy, I think, is being propped up by the government. And, with 10% plus unemployment rate, eventually the economy is going to collapse. And earnings will collapse.
Yeah.
Yeah.
But these companies, again, seem, relatively well placed compared to the average company.
Yeah. For now.
Should they be regulated, Jim, or broken up, these companies? I mean, is it bad for innovation, bad for the consumer, bad for?
I mean, so far the innovation hasn't been stunted, right? I mean, Amazon's, Google's, Facebook's of the world have pretty been good at innovation and opening up the world. I don't see any reason to regulate them, but maybe a Biden presidency that could happen.
Yeah. Is it good the industry goes through these periods, Karen? It flushes out people, or is it unnecessary?
I think it's a good thing. I don't know, Robert, what do you think?
Well, what you're talking about, I mean, I think it's the economy which flushes out.
Okay.
Flushes things out. The stock market may or may not, if you get so caught in a lot of debt and a bad start, but a good company should be able to live through a normal recession or difficult period, and certainly live through a correction like we had in March.
Right.
I mean, that's a millisecond in a company's life.
Yeah. Yeah, that's an interesting point. What other questions were you hoping to ask Sam, to Karen, Robert on the Nifty 50? It's a very interesting time because we're living through, like, when I look at Amazon or look at Tesla, sometimes it feels like we don't have facts anymore. You know, it doesn't matter if they have good numbers or bad numbers, they can go up. So,
Well, a couple of things. One, is there any of those Nifty 50 that you were hot on that absolutely bombed? Where you're like, oh, this is great. We're going to keep putting money into this one. Two, I think a good question would be more towards Jim is looking at companies like Tesla and stuff like that. When you look at it a per car, per whatever output compared to the Toyotas of the world, does that kind of give you a little worrisome on the valuation?
Looking at the list, I can't think of any.
Karen only picks winners.
Well, I tell you,
I
I-
will tell you, I recommended Philip Morris in 1967, and the shares are still owned in ICA.
amazing.
and it was saying 26 times in 1972, and I don't want to say that now, but probably in the teens somewhere.
Yeah.
So you know, some correction, but nothing dramatic compared to the others. I
It
tell
did
you,
get the single digits though in between there.
yeah. But I tell you, my mistake was probably even worse. Particularly when I was in my previous firm, which I say was a growth firm. We didn't own any of these because they were too expensive. So, of course, what we ended up doing was buying lower quality versions, which were much cheaper. And, of course, you know, when rough times came, of course, they did much worse than the quality ones.
Robert's the original Wolf of Wall Street.
You know, they did so I don't end up losing more or less, but it was a pretty lousy experience. Fortunately, I moved to Stafford, but it wasn't around for the end of some of my stocks.
Yeah, you didn't have to worry about the second half of that.
Yeah. I think it's what you were saying before, Karen. Sorry, Robert.
But I think that it's a serious point, actually, is, you know, quality, I mean, obviously it doesn't protect you completely with these kind of multiples, but nevertheless, you know, quality is worth a premium. It's a lesson that Karen always preached, and I was always reluctant to pay that premium. It was much more modest than in the Nifty 50 days, and in retrospect, it's a mistake. I mean, quality is worth a premium, and that I think is one of the arguments in favor of Amazon and Co.
You, Karen, getting back to what you said before about people that come into bear markets not being great investors, you think it's just you have to be an optimistic investor, or you have to be a positive person to be an investor long term?
I wouldn't say they're not great investors, but they had trouble.
Okay.
The S&P is compounded over 70 years at 9.7% or something.
Yeah.
And so you can't be a pessimist for long, not for very long.
Yeah. Yeah, that's great.
Although if you came into the Japanese investment business in 1989, you might be a bit like a pessimist.
I gave it up
Pessimist
in
today.
90. It was one of the better decisions.
I think, Sam, you may have stumped Jim.
No, I think he's getting ready for bed.
This game. Our first podcast with Jim, Robert, he was in bed.
Was
So
it about sleep or?
Nope, he just was laying in bed with like his iPad above his head on the pillow.
yeah, golf too much, I think, in Scottsdale. Okay. I just have a couple questions for y'all before, but should we move on from the Nifty 50? Have we covered it all?
It's pretty good.
Sure.
That's such
By
a,
the way, you do know there is an Indian index called the Nifty 50.
Yes. So before the call, like last week, I looked up Google Trends. You ever do that? It tells you, are people searching on Google a lot? And then you see a graph of it. So I saw the Nifty 50 went way up, and it was like, I think it was more related to someone going to the Indian market. But I'm like, hey, look at this graph. We're on top of it.
Or it's the first time people have been searching it in a long time, and 5 of us were searching it.
It was us. Yeah.
Yeah.
I want to ask you, Robert. Hey, Jim, are you still there? Robert, I want to ask you, are you spending enough time on space?
On space. Probably not. Probably not.
Okay. Some interesting.
You know, I think age starts to show. So I have trouble with Bitcoin, and I have trouble with plans to go to Mars. They both seem a bit far out to me.
There's
reflects old hang-ups.
There's-
Out of date.
you're probably right, but if you're a dreamer, there's some interesting things going on with private companies. And during the COVID-19 period, they have not missed a beat. They're just, it seems like working remote for them has been
Way remote.
way remote. Yes.
Are you talking about SpaceX and so on, or other?
SpaceX, and then there's 3 or 4 of them now. There's a company that's working on putting like a node on the ISS to do research, and then build out more of a launching pad to further places in space. They've made great strides this year.
Basically, truck stops in space.
Truck stops in space. Yes, exactly.
Oh.
Like a Casey's General Store. So yeah, there's been some really interesting stuff, not only on the launches, but on other things around space, telecom, and the people who are in there now are just they're some of the brightest people in the world. They seem to have shifted their focus from e-commerce or electric cars to space. It's just interesting that there's more resources there.
Presume the new Space Command is spending money in a big way, is it?
Yeah. This administration has been much more pro-space, and I think it's probably because of defense.
Yeah, I think it's more defense spending, but definitely more space.
But it's worked out to the benefit of just the commercialization of space, where you think about mining, you think about travel, you think about telecom. The other thing is COVID. You may do research up there for drug companies. It's safer. So a lot of interesting things going on. I think you would like that space, Robert.
Well,
No point intended in space.
No pun intended.
Yeah.
I need more education, Phil. Maybe they want to give it to me.
Okay, I'll send you some interesting stuff. Karen, have you heard what's going on with all these podcast shows that are getting acquired by Spotify?
Maybe you better inform me.
There's a tremendous, maybe Sam, you talk about it. Karen loves radio. And so tell her what's going on with all these podcasts. I think you'll find it fascinating.
I don't know what radio you're listening to, Karen, but like if you look at the big ones like iHeartRadio and guys like that already do podcasts.
I'll back up. I'm on the board of Minnesota Public Radio.
Oh, okay. So a lot of people are going to podcasts, kind of like this one, very important, very independent, couple sponsors, just we do our thing. But there's a couple big ones that are now going more independent, going to companies like Spotify versus being on YouTube and some of these other ones, because then they're not getting, we'll call it regulated, not getting told what they can and can't push out. Obviously the big one, like Phil mentioned, is Joe Rogan. Joe Rogan's had people on there from the crazy InfoWars guys to, Elon, to other just fascinating people. And some of the things that he brings up that are not mainstream have kind of been pushed to the side, and Spotify came to them and gave them a huge amount of money, like $100 million, and was like, we just want you to only stream on our platform, and we're going to give you X amount, and you can do whatever you want. He talked about the other day on one of his podcasts. He said the only thing that they've asked for him is, who's his first guest going to be? It's the only thing they've asked him about.
So,
Minnesota Public Radio does a fair amount of podcasting.
Okay.
Great growth area. I think people are, especially now, Karen, because you're running out of TV shows to watch during COVID-19
Yeah.
and the studios are shut down. People starting up podcasts. I mean, my wife and I can listen to Joe Rogan. Jen, probably Sam, you and your wife could listen to, like, we could listen to a podcast versus watching TV. I think that's a recent phenomenon, last 3 to 5 years, that people could say, I'll listen to the radio versus TV.
It's kind of replacing the books on tape, because it's a little bit more, it can be more real time, right? Like kind of, it could be a guy talking to you about world events that happened 2 days ago.
is there data on how many people listen to podcasts for how long?
Oh yeah. Yeah, I'll pull it up.
Because I mean, obviously, I missed out on video games. I couldn't understand how video games were so interesting. And of course, they actually dominated the entertainment space.
Yeah.
Now
They're doing really well.
so again, podcasts. I say, well, I watch a few, but I wonder how much time I spend on. But probably there are people out there who are going to replace a whole lot of other forms of entertainment. They don't read books anymore, don't read papers anymore. I guess all podcasts probably more.
It feels like it's becoming a more important educational tool or a do-it-yourself tool. And YouTube had filled that channel for a while, but I think people are going into longer format, and they may be running out of content during COVID. So I think podcasts are early.
Yeah.
I still think we're going to go through the same thing that we do with every, so we say, new product that ends up being a fad at first.
Oh, okay.
Well, video games weren't a fad.
They crashed though, one point.
Well, briefly, but basically, it's just taken over the world.
You have grandchildren, you would know.
Yeah, I mean, people watch professional video games on television.
Yeah. And Robert, kids now, they're not allowed to see each other, so they game with each other, and they watch one screen. There'll be a video like this, and then on another screen they'll be playing the video game. So especially boys between the ages of, like, what, Sam, 7 to like 13, they're playing Minecraft. It's the way that they're kind of socializing. It's
Yeah.
video games are, I think they're with us for a while. I think this podcast thing, though, is interesting, Karen, because I think it's some of them, you can get into topics where you're interested in this, it's very niche, but then someone loves it, and you can connect with people globally that are in areas that maybe you're passionate about. And that's what I find fascinating about it.
Well, the LA Opera is doing some podcasts to try and give people opera maniacs a taste of opera. The music director James Conlon is doing a series of talks on different operas.
Yeah.
And so I've been watching a few podcasts. And
That's
they're
great, right? They're really interesting. Yeah.
The question I had for my nephews, because they do listen to them, how do you decide what you're going to listen to? And it's largely by reference. Somebody else will refer them to something.
Yeah, I get a text from someone that says, listen to this, and then they tell me when, like, minute this, and then you listen to more of it. Yeah.
Well, it's the same way as your friend telling you should see this movie, right? What's the difference?
Yeah, very similar. Did you get that chart, Sam?
I'm trying to find it. They're not giving you like the actual download chart.
Oh, okay. Well, you could bring it on your screen.
Send to us later. Send to us later if you can find it.
Yeah. Okay, well, Jim had to take a call, which means we don't get Jim's commentary on Bitcoin. Did he say something at the beginning, Sam? He was excited?
He sounded very excited, and then he just disappeared on us.
We only, Karen, we only ask Jim questions on Bitcoin on 10-minute increments. How is it doing the last 10 minutes?
So Phil, you're the other Bitcoin addict. So give us your quick 5 minutes or 2 minutes.
Oh yeah, I think Bitcoin.
What's the idea what the price is?
Price right now is 9,500. It's having a pretty good year. It's up like 25%. Market's down. I think the SP is down 2-3%. Gold also is having a really great year. 2 years in a row, gold's done really well. I think Bitcoin has become, for an institutional investor, a stable investment. Volatility has come way in. It's much more stable than the equity market. And it's become, for institutional investors, I think, something they're more comfortable investing in. So, and then the fundamentals behind it, people are using more Bitcoin for transactions. It's efficient. It's anonymous. You control your own data.
So how much real transactions are done in Bitcoin? Are there figures on that too?
Yep, there are figures on that. You know what that number is, Sam?
No.
What's interesting about Bitcoin is I think people invest in Bitcoin for the blockchain. Bitcoin's just a currency, but the blockchain, Robert, is becoming integrated in all the great public companies, whether they're fintechs or whether they're logistic companies. They are adopting the blockchain and using it. And then you just have this investment crypto asset, Bitcoin, that seems to be kind of its own thing. And
the blockchain, I can see why the blockchain is a big thing, but I'm less still not clear to me why you want to transact in Bitcoins, their fluctuations, unless you're desperate for secrecy, which probably means you're up to no good.
Yeah, it could be a trust issue. Well, it's different in a stable political system, a stable economy. You have a lot of people that are using Bitcoin in very unstable regions. Bitcoin gives them liquidity, but people also use Bitcoin to buy and sell things. There are transactions that people are using, and then I think people believe in the future that money shouldn't go through third parties and should be maybe more efficient in the way that communicating has become much more efficient. Media content, it doesn't need to go through CBS. It can just go on YouTube and people can access it. So I think that friction with the intermediaries, people believe should go away, and Bitcoin plays a part in that. But it's got a way to go.
I thought there was still quite a low limit on the amount of Bitcoin transactions that Bitcoin could handle.
Yeah, that's true.
Real quick, just
No luck on
high
that.
level, Joe Rogan, 190 million monthly downloads of his podcast.
Wow.
His podcasts are about an hour and 40 minutes long.
Average. Sometimes 3 hours, depending on who he's with.
Okay, I guess Jim's not coming back. I'm gonna